I'm concerned, if what I think is about to happen is going to happen, which is the demise of the U.S. dollar, the hegemony of it, and its power and its reserve status. The question is, how safe are bonds? Because I have a friend. He has not a million. He has hundreds of millions in bonds. And yesterday I went and bought some more silver and hid them in my secret mountain vault. But he says, he won't touch silver. He says, U.S. Treasuries are it. So with that question, when he's got hundreds of millions stashed in, they talked about the eyedropper of water and a football stadium. So I think that's a very good metaphor, the eyedropper of water, eyedrop of water, and an entire football stadium. Because I think the last eyedrop is about to hit because that football stadium's almost filled up.
This is really about the power of exponential growth. And a lot of the trends that are sort of driving the world we live in at large are exponential. And the human mind doesn't do a really good job of understanding exponentials. And that's why I came up with this analogy about the magic eyedropper in the stadium. Basically, he says, look, pick the stadium of your choice. Imagine somebody takes a magic eyedropper and walks down to the pitcher's mound and squeezes out a single drop of water right there on the pitcher's mound. And that drop of water doubles in volume every minute. So minute 1, it's 1 drop in size. Minute 2, it's 2 drops in size. Minute 3, it's 4 drops in size. Minute 4, it's 8 drops in size, right? So the question is if you got handcuffed to the topmost bleacher seat in the stadium, how long would you have to escape your handcuffs before the stadium was underwater? Most people will say, I don't know, year, months. The answer is very surprising. The answer is 45 minutes. Much less time than you think. And that's just because when it doubles, each doubling is bigger than all the increases that came before it. But the really important question is what time does that happen? And that happens at minute 40. By the time you see there's a problem, the stadium's filled just a couple of minutes later, right? By the time you see the issue, it's way too late to avoid it. Your only choices at this point in time are just to sort of manage the impact. The functioning of our financial system, are you talking about the US dollar as a reserve currency, or are you talking about just our ability to afford our basic way of living? That right now, I think, is getting pretty late in the game, especially if you live in parts of the world that are really suffering right now under just crushing inflation. I don't think anybody in Europe, for example, could have ever forecasted a year ago that they would be paying what they're paying right now for energy.
Yeah.
So when you look at, a lot of times in America can't see because we're a goldfish bowl. Everybody looks in, but we don't see out. And I'm looking at what happened in Sri Lanka, what's happening in Brazil, what's happening in England, what's going to happen in Germany. We can't see it as Americans.
I think the goldfish bowl is a great analogy too, because goldfish really have incredibly short-term memories.
I'm sitting here watching all this, and so that's why I keep thinking the eye drop theory. Said when pitcher's mound is covered and I'm sitting in the top bleacher, how much time have I got?
You're right to be looking outside because collapse happens from the outside in, right? It's the weaker players that fall first. And then those are dominoes that topple over bigger dominoes. And then it all begins to progress toward the center. And yes, we live here in our fishbowl, our goldfish bowl here in the US. We do have a lot of advantages that a lot of other countries don't have. We're likely not going to be the first one to fall. We're probably likely going to be the last one. But to find out where we are in the story, we want to look out at the periphery and see how it's doing. And as you just said, Robert, the very extreme ends of the periphery are not doing well at all, right? You've got a place like Sri Lanka that's gone into full collapse, right?
Yeah.
I don't know if you saw the videos of the people storming the presidential palace. You got to remember, we saw a preview of this happen during the Arab Spring. They experienced sudden and extreme inflation in those countries, and all of a sudden, people couldn't feed their families or keep them warm. And when you get to that point, you really don't have any other option but to throw out whoever's in power, because whatever they're doing just isn't working for you, right? You're beginning to drown. That's what happened in Sri Lanka. That's beginning to happen with greater frequency elsewhere in the world. And Europe isn't in that case yet, but it's certainly a lot closer to that destination, sadly, than it was a year ago.
When Biden abandoned Afghanistan, the next day, Saudi Arabia went to talk to China and Russia. And just a couple of days ago, Saudi Arabia switched from the petrodollar, shifting to a gold-backed yuan. And nobody even notices that. So Saudi Arabia joined forces with Russia, China, Brazil, India, South Africa.
The U.S. debt crisis could ignite a long-term rally in gold.
Since March 2020, the U.S. added another $8 trillion in debt, and gold is up 50%. Buying gold and silver is a defensive strategy when you don't trust elected officials in Washington, D.C. having your best interest at heart. National Gold Group is America's #1 precious metals company. National Gold Group has the IRA fee waiver program. That means they will pay the fees on your IRA for up to 10 years on qualifying rollovers. Call 888-599-2883 to learn about their retirement account fee waiver program. Mention free investing and you'll always get best-in-class service from America's conservative precious metals leader. You can also go to their website, buyfigold.com, using the link in this video description.
When Russia invaded Ukraine, basically the U.S. weaponized the financial system against Russia, basically like seizing Russia's assets that were held abroad and whatnot. And a lot of other countries looked at that and said, whoa, like I'm in the U.S.'s good graces right now, but I might not always be.
Exactly.
And they could do that to me. So, what we've done in the response to the war in Ukraine, whatever you think about it, we have basically provided a pretty strong incentive for many countries to accelerate their plans to de-dollarize. And that's exactly what you're just talking about with the steps that Saudi Arabia took there. I certainly have heard a lot of commentary recently about the BRICS countries working on a commodity-backed currency to rival the dollar and probably going to be priced in gold grams and whatnot.
Nigeria is going to join the BRICS.
Yeah.
So they're ganging it up on the dollar. There's two more things that happened. You had the Nord Stream pipeline was bombed.
Yep.
I mean, was that an accident? Did it just happen to blow up? The other thing that happened, the reason who's the new prime or the future ex-prime minister of England tried to raise, she's gone. The shortest term prime minister in history. The whole bond market nearly came apart. Their pensions came apart. And then they had to bring a new prime minister in already. So all of this is happening.
As you go along an exponential curve, things happen faster and faster, right? And so we're beginning to see more of these really big things that we just really couldn't have ever expected would happen. We're seeing more of these things that nobody could have seen coming, more of these sort of black swans. And of course, the more they are and the faster they happen, the more the odds of something really systemic breaking and something really bad happening obviously increases.
But a big part here is they want to destroy hegemony of the U.S. dollar, which came in place in 1944 with Bretton Woods. The dollar became the gold standard of the world, or the reserve currency of the world. And then 1971, Nixon took us off the gold standard, and we went from being a capitalist state to a credit state. So everything is floating on debt right now.
Correct.
And I think bonds are debt also. I think they're going to torpedo the U.S. Treasury, and that's what we called, what the hell is a bond? You know what I mean? How safe is it? That was 2019. The repo market blew up again. The last time that blew up was 2008. And the reason the repo market is important is like repossession. Do you know how valuable is the asset that you think is an asset? Are they going to come and repo your dollar, or would they rather repo your refrigerator? Do you know what I mean? What has more value today? So in 2019, that's what blew up also. Again, how valuable is a bond?
Let's start with explaining what bonds are. Then we'll get into, are they a good place to be now or not? Because the answer is, it's a little bit nuanced, and it's a sense of like something that might not be good to be in the long term might be something good to be in the near term. And I can explain why a little bit later in the conversation. But let's start with sort of what is a bond, right? Let me contrast it with what's an equity or a stock, because I think people understand that really easily. A stock is basically just a share of ownership in something, right? I can go buy a share of Apple. It's clear I don't own all of Apple Corporation, but I have 100 millionth claim in terms of the earnings that Apple owns and the assets that it has, right? I'm a part-time shareholder in this company. A bond is not ownership. A bond is an IOU, essentially, where you give your money to somebody and they say, okay, I'm going to pay you back, but for the risk that you're taking by giving me your money, I'm going to pay you some interest as well along the way. So it's basically just a contract, and it's just math. Bonds tend to be a little bit easier to deal with because when you're dealing with a stock, you have to take into account all sorts of things. Okay, what's the potential of this company to earn money over time? And what do I discount those earning streams back at? And what's their competition doing? And maybe they're going to take over their category, or maybe they're going to be outcompeted. Bonds, it's really just much more, okay, what's the math of this contract I've entered with you? And then you have to factor in a little bit of default risk, right? Which is, okay, what's the likelihood this person's actually going to be able to deliver on what they're telling me they're going to do?
The government borrows money from you. That's a bond.
Yes. from the US Treasury. That is considered about the safest. And one of the reasons why it's so safe is, first, the US is the biggest, most stable player out there on a relative basis, but also we have a printing press. If we really get in trouble, the Federal Reserve can basically print up the money to give to the Treasury to make sure that they pay you back. So you are going to get paid back, at least nominally, meaning if I give you $100, high likelihood you're going to give me $100 back. Now, if they had to print those $100 to pay me back, then maybe those $100 are devalued a bit by inflation. But again, the US Treasury, relative basis, pretty darn safe. Borrowing from a company that's got what's called high yield debt, which is sort of the fancy way to say junk debt. This is a company that maybe isn't profitable, maybe already has a lot of debt on its balance sheet. Its prospects don't look very good. First off, you're going to demand a higher yield to borrow that debt because you don't trust their ability to pay you back as much. That's a riskier debt. So there's sort of a spectrum of bonds that are out there. Those that are considered to be very safe or those that are considered to be very speculative. And basically, it's the yield on the bonds that differ between the two. A more speculative bond should likely offer you a higher yield because that's making up for the higher risk. You may hear on the news people talk about an inverted yield curve.
Yes.
Shorter term bond yields are higher than longer term bond yields. If you want to borrow it for 30 years, I'm going to say, yeah, Kim, you're going to have to pay me more money because I'm giving you my money for a much longer period of time. When when the bond market gets nervous about where things are headed and it thinks that something bad might happen in the relatively near term, that then pushes up those short term interest rates. And so it's basically the bond market telling you, I think in 30 years, things are going to be back to normal. I think we're going to be okay in the long run, but I think we're going to have some rough times in the very near future. And that's why I'm going to demand a higher interest rate in the short term.
Yeah, so let me give you a really simple. So you have a 5-year bond, let's say, and you're getting paid 5%, whereas a long-term bond is paying 1%. That's an inversion because it should be the other way. The longer-term bond should be paying 5%, but short-term is paying 1%. That's when the higher math kills me at that point. Anyway, the shorter-term bond should be less interest, but today the shorter-term bonds are higher interest than the long-term bonds, and that's the inversion.
Two important things about it. One, an inverted yield curve is one of the most dependable signals we have of approaching recession. If you see an inverted yield curve like we have today, you should say, all right, look, I got to get prepared that we may be entering a pretty material recession in the not too distant future, because whenever we've seen this before, it's happened. And right now, as you guys know well, we've got a big inflation problem around the world, but certainly in this country. Most central banks, definitely the Fed, are hiking rates right now to get inflation under control. Now, we have an economy that has gotten extremely used to, some would say addicted to or dependent on ultra low interest rates. That the Fed brought them down to, zero at a period of time. It kept them really low, lower than they'd been in some cases in recorded history. And the system habituated to that. So now that rates are rising, they're rising pretty dramatically, and we've raised rates faster than we ever have in the data series. Let's say I gave you, Robert, a gallon of water and I told you had a week to drink it. You'd have no problem with that, right? But let's say I just shoved it up against your face and I just forced it down your throat all at once. You might actually choke and drown, right? Same amount of water, but it's the rate of change that's the different point there, right? So we're shocking the economy right now by bringing rates up to a point where the economy is not used to rates being this high, may actually not be able to function at rates this high. And we've done it in such a fast period of time that it's literally like shocking the financial system here.
So what has happened is that as interest rates kept coming down because they wanted people to borrow and stimulate the economy, our debt went this way. As interest rates came down, the Fed printed more money and our national debt owed by the taxpayers kept going this way. But the moment they raise interest rate, that debt is going to kill us because it's too expensive.
Exactly. The debt service payments all of a sudden become a lot more burdensome.
And who pays that? Our taxes. Who pays the debt are the U.S. taxpayer. So mom and pop get screwed again because they use that cash, the low interest rates, to bail out the banks, and that we're in trouble. In 2008, things says all this is going up and down, and that's why I'm going, this is a little too tough for me because I have a simple little brain here. And do you know what? The question is, because interest rates are going up, prices of gold and silver come down. because everybody wants the higher interest rates than gold and silver will pay. So this whole thing just gyrates the entire world. So that's why you're here. I make $1,000, I spend $800, I got $200 left. I take that $200 and now where can I put it? If I buy a bond, I can do that. I can buy some chewing gum with it. I can do what I want with it. But I never had any money to buy a bond anyway. When I was in elementary school, they had to buy U.S. savings bonds. I think they're 1875. And after 10 years, I got $25. It just didn't stimulate me. You know what I'm saying? 1875 to $25. And my poor dad kept saying, it's a good deal. And my rich dad says, you're being screwed, because of inflation. So I was totally messed up by the time I was 10 years old. If you had $1,000, where would you put that money? Would you put it in bonds? Would you trust it to the government? There's corporate bonds, there's private bonds, there's so many different types of bonds, muni bonds. And this whole program started because my best friend, who just sold his business for $2 billion and walked away with a lot of cash in his pocket, he's 100% in bonds. I'm going, but what happens if the dollar goes bad? You have dollar milkshake there, the eye drop thing, but if your eyedropper is filled with yen or pesos or euro, it's going to come faster than the dollar, US dollar, I'm saying.
Well, absolutely. And that's why you have to worry if you live in those countries.
Right.
If you live in Japan, you have to be preparing for
now.
How much time do you have left? You've got an awful lot less time than the folks sitting in a stadium inside the US, right? And that's why I said kind of where you are really matters in the story in terms of how much time you have left.
What's safe right now is a can of tuna. I got one for 20 cents the other day. And there's no counterparty risk to my can of tuna because if Safeway or Albertsons goes broke, I still own that tuna. But if I buy a share of Safeway stock and Safeway goes down or Albertsons goes down, my stock is gone too. So I think tuna fish are the safest of all investments today.
To protect yourself against the abuse of currency and the rising cost of living, hard assets are, I think, one of the safest long-term assets that you can invest in right now, particularly hard assets that create an income stream, because most hard asset income streams will adjust along with inflation, right? So this can be real estate, this can be commodity producers, but to a certain extent, Robert, maybe you're saying it tongue in cheek, I don't know, but like stocking up on extra cans of tuna right now is not a bad thing given where food prices have been heading and can continue to head.
Yeah, and tuna is a derivative of diesel, because it takes diesel to fill the shipping fleets up.
And most people don't understand the absolute essential role that energy plays in the economy, because nothing happens, no economic activity happens without the energy to power it. And if you care about the pricing of things, you have to be aware of what the energy input costs are for that individual product. Most products require a lot of energy. If you want to get a tuna, well, yeah, it's a fish in the ocean. You would think no energy is involved at all, but you got to basically manufacture the boats to go out there and fish. You've got to put the diesel in for those boats. You could then, in most cases, most fish that's actually sold in America and caught off American shores is actually sent to China to be processed before it comes back here and is put in the can. There's just a ton of energy, embedded energy that goes into everything. You've got to really look at your vulnerability to energy costs. And again, they've gone bonkers over this past year, given what's been going on with global supply chains, the war in Ukraine, et cetera.
National Gold Group is Consumer Affairs' top-rated gold IRA dealer. Call 888-599-2883.